Hello, and welcome to our third webcast on transfer pricing. I'm Ioanna Stylianidou. I'm leading the transfer pricing services at PwC Cyprus. And together with my team members, Christina, Eleftheria, Marios, and Fodini, we will share our thoughts on how to prepare for the first transfer pricing documentation deadline in Cyprus. The introduction of transfer pricing documentation requirements in Cyprus is now effective as from the 1st of January 22, and it was not really a surprise. We were expecting them for some time, and this derived mainly from developments in the international tax field, the need for increased transparency, and the evolving practices of the tax authorities, not only in Cyprus, but worldwide as well. So the first transfer pricing documentation deadline is on the 31st of March 24. That's for tax year 22, and it's approaching. It's less than 4 months away. So as we are seeing, the degree of readiness at this stage varies significantly between taxpayers. Some businesses have already fully complied, and others may not have realized how they are affected. So our aim today is to have, firstly, a very quick recap of the transfer pricing documentation requirements with Christina. And then Marios and Eleftheria will share some of our experiences, focusing on practical aspects of compliance. Fodini then will wrap up, aiming to give you more clarity on how to prepare for the upcoming deadline, despite whatever technical complexities there may exist. Please send us through any questions you may have, and we will be happy to address them at the end of the webinar. So over to you, Christina.
Thank you, Anna. So let me give you a brief overview of the transfer pricing documentation requirements in Cyprus as from tax year 2022. Taxpayers are now obliged to prepare a summary table, a master file, a local file, or a minimum transfer pricing documentation. Starting from the summary table, it must be prepared by all taxpayers that engage in transactions with related parties, irrespective of threshold. The summary table includes details of the transactions, such as the names and tax identification codes of the related counterparties, as well as the arm's length value of the transactions in aggregate per category of transaction per year. The summary table should be submitted annually in an electronic format by the deadline of filing of the income tax return for the year concerned. So for tax year 2022, the first summary table must be submitted by 31st March 2024. Currently, the authorities are in the process of setting up the electronic mechanism for submission of the summary table. For this year, it is expected to be done as an electronic filing separate from the income tax return, but with the same deadline. In the following years, a joint submission may be implemented. The authorities have issued some guidance in the form of frequently asked questions that you will need to consider. For example, you do not need to include loans from related parties that were used to finance the purchase of investments and for which the interest expense is not claimed as tax deductible. Also, for loans, the value should reflect the maximum amount of the principal amount plus accrued interest at any point in the year. Moving on to the master file. Essentially, the required contents of the master file are in line with the suggestions of BEPS Action 13. So the master file includes primarily information for the group, its organizational structure and global footprint, its key drivers of profit and value chain, a description of key intra-group arrangements and transfer pricing policies, with particular focus on the intangibles and financing arrangements of the group. It should also refer to any key restructurings and present the tax and financial positions of the group. Most Cyprus resident companies are exempt from the master file obligation because it applies only to those Cyprus entities that are the ultimate parent or surrogate parent entity of a multinational enterprise group that falls under the scope of country-by-country reporting. In other words, it is for groups that have annual consolidated revenue exceeding 750 million euro per year, or other persons are exempt from this obligation. The master file has to be prepared and updated annually by the deadline of the filing of the income tax return for the relevant tax year and should be submitted to the Cyprus Tax Department upon request, and specifically within 60 days from the notification of such request. Master file should be maintained in electronic or hard copy format and may be prepared in English language. The local file now focuses on the local entity. The required contents of the local file are in line with the suggestions of BEPS Action 13. So it requires a detailed analysis of the company's activities, business strategy, as well as a description of the intra-group transactions. The Cyprus local file also includes a thorough description of the process that was carried out to determine the arm's length nature of the related party transactions of the company. This includes the detailed functional and risk analysis, selection of the most appropriate transfer pricing method, and an explanation of how the selected method was applied in order to determine the arm's length remuneration for each transaction that falls under the scope of the local file. So the local file will also include the appropriate benchmarking analysis and a conclusion of whether the prices of the related party transactions were reflected in the taxable profit on an arm's length basis. So the requirements to prepare a local file is compulsory for Cyprus tax resident persons and also permanent establishments of non-Cyprus tax residents situated in Cyprus that engage in related party transactions with arm's length value more than 750,000 per year per transaction category in aggregate. With respect to the timelines, the local file must be prepared and updated annually by the deadline of the filing of the income tax return for the relevant tax year and should be submitted to the Cyprus Tax Department upon request and specifically within 60 days from the notification of such request. Cyprus local files can be maintained in electronic or hard copy format and may be prepared in English language. It is important to note here that the local file needs to be subject to quality review by a local practicing auditor if prepared internally or by advisors outside Cyprus. This review must also take place by the deadline of preparation of the local file and filing of the tax return for the respective tax year. Let me now briefly describe what transfer pricing documentation is required for those transactions that fall outside the scope of the local file. As per the circular issued by the Cyprus Tax Department, the taxpayers need to maintain a minimum transfer pricing documentation to support the arm's length nature of the related party transactions that are not documented in detail in the local file. The minimum transfer pricing documentation should include a brief functional analysis, the reasoning for selection of the most appropriate transfer pricing method, and the relevant benchmarking or other economic analysis to determine the arm's length price range. The minimum transfer pricing documentation may also be prepared by the deadline of the income tax return and should be submitted upon request by the authorities. Finally, let me mention that the circular issued by the Tax Department also provides for safe harbor rules. Specifically, instead of preparing the minimum transfer pricing documentation, the taxpayer may elect to apply safe harbor rates for specific transactions. For example, safe harbor rates can be applied for financing in nature receivables from related parties that are funded by borrowings or equity, for borrowings from related parties that are used in the business, and for low value adding services received or provided. In the case where the taxpayer elects to apply the safe harbor rates, then it will need to document the eligibility and application of such treatment. A final point to mention here is that the election of safe harbor rates triggers tax 6 reporting obligations. So in summary, all taxpayers that have related party transactions must prepare a summary table, and they also need to prepare a local file or maintain a minimum transfer pricing documentation to support the arm's length pricing of their related party transactions. Safe harbor rates can only be applied for financing transactions and low value adding services with values less than 750,000 euro in aggregate per category. Finally, the master file requirements applies only for ultimate parent entities of groups with more than 750 million euro consolidated revenues.
Thank you, Christina. Indeed, the most common transaction type that we see in Cyprus is financing transactions. The OECD has issued extensive guidance on how to determine the pricing of such transactions. Some financing transactions are fairly straightforward to be estimated. while some others are more difficult, complicated, and require elaborated analysis. The most usual example that we see is a straight loan between two related party entities. And as with unrelated parties, there are two perspectives. There is a perspective of the lender and the perspective of the borrower. From a perspective of the lender, a lender must be confident that the loan will be repaid on time to lend the funds. And from a perspective of the borrower has to understand as well the risks that the borrower is getting into and decide whether to enter into a transaction. Both the lender and the borrowers make an assessment of their risks. The lender as well manages and monitors the risk after the loan is provided, and they jointly decide the terms and conditions of the transaction. They jointly decide basically the seniority of the loan, whether collateral will be in place. They decide the currency of the loan, and obviously the maturity of the loan. In some cases, what we see, and this is really usual in Cyprus, in the Cypriot cases that we see, there are some transactions because the transacting parties feel the safety of being in a group, of being related parties. They feel the safety to transact in a way which is not comparable in the market. Because these transactions might look different from what would have been agreed between unrelated parties, these transactions sometimes might be considered, there is the risk that they might be considered as being of capital nature and not as being financing transactions. This is a risk that needs to be carefully considered. The usual process we follow to determine the arm's length pricing in this type of transactions is to rely on internal or external comparables. Sometimes we are lucky and we can find within the group, or even the lender might, or even the borrower might have borrowed previously from a third party, and we can rely on that interest rate to build our analysis on. In some other cases, which is the vast majority, actually, we cannot rely on internal comparables. There are no internal comparables to rely on, and we have to perform a benchmarking analysis to determine the interest rate, the arm's length interest rate of the transaction. The process typically relies on the risks exactly of the transactions, which actually are encapsulated by the terms and conditions of the transaction. So we benchmark for the maturity, the same currency, the maturity, the currency of the transaction, and the issuance date of the transaction to find the interest rate. Now, this can be really complicated in Cyprus, as some transactions can really be complicated due to the nature of the borrower. We see a lot of holding companies in Cyprus, and those hold assets which has to be carefully analyzed. The underlying assets has to be carefully analyzed. The major factor which we rely on to analyze the risk of the transaction, which is also what we use as the main factor in the benchmarking analysis, is the credit risk of the underlying portfolio those companies hold, or of the borrower if it's an operating company, and this credit risk is indicated by the credit rating. We find this credit rating sometimes available within the group, as some companies are rated by credit rating agencies, or we estimate the credit rating if this is not available within the group. how we approach this is to typically use publications, again, from credit rating agencies, which describe quantitative and qualitative factors to take into consideration to determine the credit rating. It can be a really difficult and complicated exercise, especially when the underlying portfolio needs to be analyzed one entity by one entity, one asset by one asset, as this can create issues in the credit profile of the company, of the borrower. Let me now focus on another type of transaction, IP-related transactions. This is a transaction that we see more and more often lately in Cyprus, as there has been investment in the ICT sector in Cyprus, which is a sector which relies on IP and produces IP. Those companies rely on software and produce software as well. This is, of course, an example. There are many other examples we can give, but the ICT sector in Cyprus lately has really been a sector which has been intensive investment. So a typical setup is an IP, a licensor who is the legal owner, the legal IP owner of an IP asset, and a licensee who uses the IP licensed by the licensor for if it's a software, as an example, might be for the production of other software as well. What we have to do from a transfer pricing perspective is to determine the fee that will be charged, the royalty fee that will be charged by entity A to entity B, to be certain that this is at arm's length. What we have to do to proceed with this type of analysis is to understand, again, the functions and the risks of this type of transactions, and particular attention must be given to the so-called DEMPI functions: development, enhancement, maintenance, protection, and exploitation of those type of assets. It can be the case that other entities within the group provide have this functionality that provides the IP value, that contributes to the IP value. And when this is the case, entity A might really be characterized as being a mere administrator and not really a company who economically owns the IP, but only legally owns the IP. In such a case, entity A obviously cannot be remunerated fully with the royalty fee, but the other entities, the underlying entities contributing to the IP value, have to be remunerated for this type of service. And this is an example here in the slide. That entity, another entity C, is a developer of the IP. Another entity is enhancing and maintains the IP. And another entity provides the legal protection. So in this scenario, we have to find a way to split the profit generated from the IP. It's a really complicated exercise as well. It's not as easy as just performing a benchmarking analysis for royalty fee, but if there are multiple parties contributing to the IP value, we have to take this into consideration and proceed with a careful analysis of the situation, and yes, to split the profit generated. And over to you, Eleftheria, for the services and goods.
Thank you, Mariam. So now we will dive together into the dynamic world of transfer pricing for distribution of goods and for the provision of services. Starting with the distribution of goods, in transfer pricing, we typically see three types of distributors. And these are the limited risk distributors, fully fledged distributors, and commissioners. It is important to distinguish the role of each type of distributor by performing detailed functional analysis to the relevant people and teams, so as to have a clear picture of their role in the supply chain of the business. This classification is closely connected with the selection of an appropriate transfer pricing method, ensuring that the pricing is accurately and reflects the economic substance of the transactions between the related parties. Starting with the limited risk distributors, they typically take minimal risk in the supply chain, and this may involve having little to no involvement in product development, marketing, or after-sales services, as its focus is mainly and primarily on distribution of activities. Limited risk distributors usually do not actively participate in strategic decisions or bear significant financial risks. From a transfer pricing perspective, and given their limited role and risk exposure, limited risk distributors are often compensated with lower profit margins. Cost plus or fixed markup methods are commonly applied. When it comes to full-fledged distributors, they usually take on a more comprehensive role in the supply chain of the business, as they may be involved in marketing, advertising, and may bear additional risks such as inventory management or credit risk. From a transfer pricing perspective, their increased responsibilities and risks make full-fledged distributors being compensated with higher profit margins, and comparable and controlled price or resale price methods are often applied. Commissioner is a distributor that operates as an agent, earning a commission for facilitating the sale of goods without taking on the risks associated with the ownership of the inventory. The legal title of the goods often remains with the principal. The transfer pricing for commissioners involves determining an arm's length commission for the services provided, and it's important to compare those with commissions charged by unrelated parties. From our experience, we have seen that when dealing with distributors, internal comparables are very frequently used. For example, comparing the pricing of the limited risk distributor with other internal comparables helps in determining whether the profit margin allocated to the limited risk distributors is in line with what would be expected between unrelated parties engaging in similar activities. The process followed for analyzing internal comparables is the same for all three types of distributors, starting with identification of transactions within the corporate group, where same type of distributors are involved in similar activities. But what happens when internal comparables are not exactly the same? So in such a case, adjustments may be necessary to align any differences between the distributor under review and internal comparables. This could include adjustments for variations in market conditions, product specifications, or other relevant factors. Right? And let's focus now on how transfer pricing guidelines specifically apply to the provision of services. This is extremely important to establish fair and arm's length prices between the related parties. Let's start with the application of the benefits test, where we analyze whether the services provided yield identifiable and quantifiable benefits to the recipient, aligning with the economic substance of the transactions as well as the pricing applied. The benefits test discourages the provision of services that don't genuinely enhance the recipient's business position and helps prevent the charging of fees for services that might be considered unnecessary, duplicated, or they lack in substantial economic impact. Proper documentation is key to substantiate that the services indeed provide economic benefits. I note here that some functions that the related entity performs in its capacity as shareholder are not considered as chargeable services, and therefore the costs associated with such functions cannot be allocated to the subsidiaries. Without a robust benefit test, there is a risk of either overcharging or undercharging of services. Overcharging could lead to disputes with tax authorities, while undercharging may result in erosion of the tax base. So the benefit test acts as a safeguard against these risks. Once you establish that there is an intra-group provision of a service, you need to ensure that the charge for such service is at arm's length. In most cases, a cost-plus or a cost-based TNMM approach is selected. This means that you need to identify the cost base on which an arm's length markup may need to be added. On that basis, I would like to highlight the importance of performing a thorough cost analysis and establish fair and arm's length prices, starting with the identification of direct costs, which are the specific expenditures directly tied to the provision of particular service or to a specific service recipient. On the other hand, indirect costs are the overhead costs and incurred to support various services, but are not directly attributable to any single service or service recipient. The question that might arise in the allocation of indirect costs is how these will be fairly distributed among different service components or service recipients. Allocation keys, such as the number of labor hours spent on each service, the revenue generated by each service, allocation costs based on the number of transactions or service units, can be effective for businesses offering transactional services. For labor-intensive services, the number of employees associated and time spent on each service could be more relevant allocation keys. Let's now discuss the approach we should take when a markup should be applied so that the transaction is priced on an arm's length basis. First step is to identify the nature of service provided. For example, if it's of a high-value strategic service and involves specialized expertise or innovation, it may receive a higher markup. Routine or low-value services, on the other hand, may have a lower markup to align their relative contribution. If we take as an example, let's say a data analytics consultancy offering advanced predictive modeling services, it may receive a higher markup compared to routine data entry services. The markup should include a reasonable operating profit margin reflecting the functions performed and the risks assumed by the service provider. This margin goes beyond cost recovery and ensures that the provider is fairly rewarded for the value it adds. In some cases, no markup needs to be applied on certain costs, and these are called pass-through costs. Pass-through costs are passed through directly to the recipient without any additional margin or profit for the provider. The recipient pays only the actual cost incurred by the provider in the transaction. The service provider operates as an agent or intermediary with respect to these costs and therefore should not apply a markup on their value. When documenting pass-through costs, a thorough documentation of the methodology should be prepared so it provides a clear record of the factors considered, ensuring compliance and serving as a valuable reference in case of audits or tax inquiries. And with this closing remark, I will pass the floor to Fotini, who is going to share some suggestions from a practical perspective. Fotini?
Thank you, Eleftheria. Over the past half hour, my colleagues have shared information in relation to the transfer pricing documentation requirements and our experience and observations from a practical perspective. We've steered away from analyzing complex technical aspects, and our aim is to focus on the practical elements of transfer pricing readiness and compliance, particularly as the first transfer pricing documentation deadline is fast approaching. Taking a step back to basic principles, transfer pricing and the arm's length principle govern the way multinational affiliates transact between them. For example, via financing, intangible property, products, and various service flows that Mairos and Eleftheria have previously mentioned. Our tax legislation in Cyprus requires that transactions between related parties are priced on an arm's length basis, as if the companies were independent from each other and acting in a potentially comparable transaction. Taxpayers are expected to be able to explain and support the pricing of their related party transactions and maintain appropriate documentation to demonstrate to tax authorities that their intra-group transactions are at arm's length, which Christina described earlier. If during a tax audit, tax authorities view that transfer prices are not considered as arm's length, then adjustments to the tax base may be triggered, resulting in additional tax burden, possible double taxation, imposition of penalties, compliance, and administrative costs. Therefore, compliance with transfer pricing documentation obligations is important and could in fact create efficiencies. While the arm's length principle and the required contents of the summary information table and local file are clear, as Mairos and Lefteria mentioned, the complexity arises when you begin to consider how you determine arm's length prices, how independent parties act, who performs key functions and controls the risks in generating profit, what methodologies can be used, what data is available, and what assumptions are necessary. One of the most common pitfalls arises due to the inherent challenges in applying the arm's length principle in practice. On the one hand, it is very fact-based and requires a good understanding of industry-specific models, while on the other hand, it is also acknowledged that one size does not fit all, and there is a range of reasonable outcomes, all of which make it relatively easy for tax authorities to challenge transfer prices, leading to uncertainty around actual tax liabilities. In our experience, and I'm sure you've also come across discussions of the same nature, it's fair to say that in the lead up to the first transfer pricing documentation deadline, there are two primary views for how to approach the preparation of your group's transfer pricing documentation. One approach views transfer pricing as a costly burden and a timely exercise with a limited value, while an alternative approach views transfer pricing as an opportunity to generate value, align your model to the commercial objectives of the business, and mitigate the risk of challenge by developing robust and pragmatic transfer pricing policies, particularly in complex group structures. So I'd like to stress the importance of investing time and resources at the onset and of following a holistic approach to your transfer pricing arrangements, as our experience has demonstrated this leads to efficiencies. The slide on screen illustrates the importance of transfer pricing within a group and how this has evolved over the years. Up until recently, a group's intra-group arrangements were determined by the business, with oversight from business leads, while the transfer pricing aspects were considered only for compliance purposes and for preparing documentation about what was understood to be happening on the ground. Tax audits also covered transfer pricing aspects, but in most cases not extensively. In Cyprus, transfer pricing issues were only a very small part of the tax audit, focusing primarily on some financial transactions. Also, disputes involving other tax authorities were not that frequent. However, at the backdrop of international tax developments, we have observed a shift in focus on transfer pricing, as it determines the allocation of profits between jurisdictions and entities, and therefore has an impact on government revenue from taxation. For this reason, tax authorities in Cyprus and globally require more transparency and information about the intra-group pricing aspects that affect taxable profits. And as businesses are becoming more global and more complex, we see that changes happen very quickly because of commercial reasons, regulatory reasons, technology or pandemics that affect global mobility and the new conditions under which people are willing to work. All these result in more complex intra-group arrangements. Therefore, in the new norm, transfer pricing plays a critical role in the structuring of activities, the development of intra-group policies, and oversight of how these work in practice. This enables the proactive identification of transfer pricing risks, especially in ever-evolving and increasingly complex organizations, where funding needs, employee mobility, and technological advances, for example, may trigger changes in the business model. Taking a simplistic approach towards transfer pricing compliance, or even resistance to compliance, will have a negative impact on the business in most cases, as it is near certain that such approach will not provide adequate defense against challenge from tax authorities. So, how do you prepare for transfer pricing compliance that provides adequate defense while being efficient and effective at the same time? The starting point for your transfer pricing documentation compliance is to plan and get organized. The first step is to identify all intercompany arrangements within the scope of the transfer pricing documentation requirements. Think about your cross-border transactions and your domestic transactions. Both fall under the scope of documentation in Cyprus. Identify transactions that are supported by existing legal agreements, but also other arrangements which may not be formally documented. You then need to understand what type of documentation you need to prepare, what should be submitted, and what should be retained and be submitted upon request. You will probably need to prepare a summary information table and local file of minimum TP documentation for those transactions that are below the local file threshold. A few entities will also have the obligation to prepare a master file. Ownership and accountability for the process of transfer pricing compliance needs to be addressed at this stage. The second step is to capture all relevant financial and non-financial data for your transactions. This will include underlying legal agreements, headcount data, and internal policies, amongst others. Identifying the key persons that can provide input for the functional analysis is also very important, because as mentioned before, actual conduct prevails what is written in contracts, and the transfer pricing documentation needs to present the facts in an accurate manner. Also, at this stage, you must look within the group and understand what transfer pricing documentation is available at a group level. This is important for two reasons. One, to avoid unnecessary duplication, and two, also to ensure consistency. These initial steps will enable your internal capabilities or external advisors to prepare the transfer pricing analysis and documentation through a phased approach. The OECD transfer pricing guidelines recommend a process of 9 steps, which is considered best practice, with particular focus on the functional analysis and selection and application of the most appropriate method. So firstly, a comprehensive functional analysis needs to be performed by reviewing and assessing the information gathered, as well as accurately identifying the functions performed, assets used, and risks assumed of the parties involved in the controlled transactions. Therefore, looking at where substance lies and how where value is created. A comparability analysis should then be performed to identify and select the most appropriate transfer pricing method for each controlled transaction, followed by an economic or benchmarking analysis to identify the prices of comparable transactions or results of entities that can be used to determine the arm's length price range for the controlled transactions. A significant next step is to then analyze and understand the impact of the transfer pricing analysis performed on your taxable profits and assess whether any adjustments to the taxable profits might be necessary or whether any risks may exist. Such adjustments may have an impact on the counterparty, and these may need to be analyzed. If the adjustment creates inefficiencies and double taxation, you may need to find ways to resolve them and improve the overall outcome. The findings may indicate that adjustments or refinements to your operating model are needed. At this stage, you will also need to check whether your legal agreements accurately reflect the related party transactions or whether they need updating. The subsequent step will include the finalization of the transfer pricing documentation and appropriate submissions where relevant, with a target of the 31st of March 2024. And remember that all reports, appendices to the reports, detailed workings and memos relevant to the documentation files need to be retained so that they can be presented to the authorities if needed during the tax audit stage down the line. Also, people and systems may change, and therefore you need to ensure that those supporting documents are available and accessible. The key thing to remember in all that we have discussed is that proactiveness and preparation reduces uncertainty. Rigorous transfer pricing analysis and thorough contemporaneous documentation are becoming critical, and eventually they result in greater efficiency and lower costs. Remaining aware of developments in transfer pricing legislation and the practices of tax authorities is also important. It's clear that there is a need to address transfer pricing as a more holistic, end-to-end process, which draws together the wider chain of activities into a well-defined set of procedures, from strategy through to financial and operational systems, to local financial statements and tax returns. Ioanna, any final words?
Thank you, Fotini, and thank you, Christina, Marios, and Eleftheria, for your insightful presentations. So just to close, what are the key takeaways and what are the next steps? I would say that transfer pricing documentation is now a formal requirement, and our tax authorities are very eager to collect and examine it as part of their tax audits. So non-compliance, most probably it will just lead to additional taxes, it may lead to penalties, high administrative costs. And even though in the first year of compliance, the task of preparing your transfer pricing documentation may seem a little bit daunting, I think that there is value in addressing it properly. And by saying properly, that does not mean that you need to overanalyze and make the process more complex and more expensive than what it needs to be. By proper preparation, you can identify synergies in areas that may not be very important, but at the same time, you may identify areas that are important and need to be addressed in detail. You know, what they say is that the best way to resolve disputes with the tax authorities is to be properly prepared and be prepared before the dispute actually arises. So that's all that we had to cover today. Thank you very much for submitting your questions. I think we have time to answer a couple of them. For any other questions that we don't answer, we will forward replies to you directly because they may be related to specific and more technical elements. So one question that I have seen come through a couple of times is regarding penalties. So the question says, so what if I do nothing? What penalties may be imposed and what will happen to me? Christina, would you like to answer that, since it's part of the requirements?
Sure, yeah. Starting from the summary table, a 500 euros penalties will be imposed to the taxpayer if they fail to complete it and submit it by the deadline. For the master file and local file, the penalties escalate from 5,000 to 20,000, depending on the delay. A 5,000 will be imposed if the master file or local file is submitted between 61 days and 90 days. A 10,000 euro penalty will be imposed if the files are submitted between 91 and 120 days from the request from the tax authorities. And a 20,000 euro penalty will be imposed if they're submitted after 120 days or not submitted at all. But it's worth mentioning that regardless of the penalties, the transfer pricing documentation can be used as a defense file, as Joanna and Fodini mentioned, in order to resolve any disputes during tax audits. Therefore, doing nothing is not really a suggested approach, a way forward. Yeah,
thank you, Christina. One more question has to do with documentation that is prepared at group level. And the question is basically, we have documentation that is prepared by the group. Why do we need to prepare something locally? Well, you need to prepare something locally because there is a local documentation requirement. So this means that the Cyprus entity needs to have its own local file or minimum transfer pricing documentation to include the transfer pricing analysis for its related party transactions. But what you could do is basically utilize whatever documentation that you have at group level or at the counterparty level, and see how you can assimilate that into the local file and have it subject to a quality review by a local practitioner. And that we have seen it in practice being applied many times, and that can be sufficient without having to redo and reperform analysis and exercises. Let me have a look. Okay, there is one more question that I think is important, and it has to do with local transactions. And why should businesses operating only in Cyprus without any cross-border transactions have to bear the cost of preparing transfer pricing documentation? Well, again, for that, it's a legal requirement, it's a compliance requirement, and therefore you need to prepare something. Having transactions between two Cyprus tax entities does not necessarily mean that there will always be increased profit in one entity and an increased expense in the other, and therefore everybody will be in the same position. There are cases where that does not happen. There are cases where you don't have wholly ownership of the two entities, and there may be room for manipulation there. In any case, domestic transactions are covered by the Cyprus legislation. However, when you deal with domestic transactions, you need to be careful not to overanalyze and to see what information is available that can be used. In many cases, there are internal comparables that can be used instead of searching for external comparables, or there may be more simpler ways to address those transactions. But of course, that will depend on the specifics. And as my team members mentioned before, you really need to look at what information is available and how you can best utilize that to create your transfer pricing documentation. Okay, so thank you very much for attending our webinar. We will share a link with the recording for future reference. And please, if you have any more questions or if you have any thoughts after the webinar, send them through and we will contact you directly. So thank you very much. Have a nice afternoon.